I want to explore this risk bit a little bit more with you, Chitra, because there is a general sense, people who are not very familiar with the equity markets, in fact, one of the reasons perhaps a lot of people, I would use the word, are scared of getting into the equity market is because they feel it's a gambling den. They feel it moves so fast and you could one day be really up and one day be totally down, which is what we call volatility. And therefore, they perhaps feel that I could lose all my money. Now, while it's worth reiterating that risk to them, but how would you explain to people that it is not a gambling den, it is not a place where you necessarily have to lose all the money that you have while that risk exists? What would your advice be to people?
Let me start by saying that if you look at, for example, how the market has moved over a long term, let us say you take an 8 or a 10-year time frame, you will find that the market has returned on an overall basis anything upwards of 12 to 15%, right? For the market as a whole. And there could be particular portfolios, baskets that have returned much more. So, I think the general sense that one may lose everything is not evidenced by the way the market moves, right? So, if that is true, then it's all about how we make these investment decisions, how we decide to put monies into the market. Definitely, it is being risk capital, one has to understand the investment that one is making into the market. Second, one has to be clear the horizon for which one is investing. Right? The observation that you made, the markets go up, go down. When you look at it in a short horizon, that's what it looks like. But when you look at the annualized return of, for example, the market over 10 years, and if it is 12-15%, the returns don't seem to be that volatile when you compare it to the horizon. And there are people who have managed portfolios and who have got significant returns out of these portfolios because their investment objectives are clear, and therefore the horizon for which they invest and what they invest in is a fallout of that.
What is day trading?
Day trading, as the name indicates, really is one where the horizon is a day.
And how would you define this day trader different from an investor who should be doing, for instance, what you just mentioned, of being there for the long term and perhaps mitigating his risk? Why should one not be a day trader if you don't have the knowledge? Can you define these two and explain that to our viewers?
To sort of spend one moment on what we mean by a day trader, you're absolutely right. Today, the market day is a morning to evening, 9 to 3:30 window. Now, typically, the day trader is following a strategy by which he picks some scripts, and in those scripts he has, let's say, a directional view, and based on the directional view he is buying, selling at very, very short spurts of time, which could be every second, or every minute, and so on. The idea is not for him to build a holding. The idea for him is to basically make a revenue or a profit out of price differences and out of a buy, sell, and closing out the positions by the end of day.
Is that where the danger lies? That sometimes if there's a sharp movement, you could end up losing a lot of money?
You require a different skill set to be a day trader. Every investor cannot be a day trader. And the objectives of the day trader are different. Risks are naturally, therefore, different.
What are these skills?
See, typically, as I said, the day trader is not exactly looking at the fundamental, strength of a company alone, or whether this company will give this sort of an annualized return. Okay, is this diversifying my portfolio? He is not really going to be looking at any of this. He has his own analysis, which shows or which gives him the leads on which are the stocks on which he can make directional gains. When I say directional gains, it doesn't mean the stocks will be moving only up or only down. The day trader has an ability to make money whether the stocks move up or they move down. For him, the situation is that the price movements in those spurts of time, he takes buy-sell positions by which he is able to make a net gain or a loss. This is not the way an investor
Is
will
this
approach.
based on an understanding of that company's shares, or is it based on getting some kind of a tip or getting some kind of an information which could be not available to others and therefore trading on that?
No, the day trader doesn't really only pick scripts, where there is some specific information. There may be absolutely no information in stocks. There could be day traders in your top 50 scripts every day. They are essentially liquidity providers. That is the role that they play, because what they are really doing is at every price point they are buying and selling. That is what gives the depth to the market. I'm not saying that's the only thing, but the traders essentially provide liquidity to the market, any market. So they don't really go by tips or specific information. Day trader will pick scripts based on his own analysis of liquidity, movement, where he can make some directional gains, etc.
Well, we have come to the end of this first part of our lesson, but before we go, let's revise what we've learnt today. All right, thanks very much, Chitra, for joining us today. We will be back next week with lots more questions on how equity markets really work. Please come back with us next week. We'll continue this class. Thanks for watching.